Yahoo Finance's Inez Frey joining us here to break down the moves today. Inez, what is the latest?
Well, Josh, we are in the green. So we ended the session in the green for the Dow up about 500 points or 1% off the session highs, but nevertheless in green territory. We saw the markets rally during Fed Chair Jerome Powell's speech. Also looking at the NASDAQ composite up 0.3%, erasing earlier session losses, and the S&P 500 just a hair off its all-time high, just closing just a few points below its all-time high from October. Taking a look at the Treasury market, we are seeing that the 10-year Treasury note at 4.16% eased just about by 2 basis points. The 30-year also at 4.8%. Taking a look also at the U.S. dollar index, that eased somewhat during the session as well. And you saw gold futures that edged higher and the silver as well. Over under the hood in equities, we have seen the leadership throughout the day in materials, industrials, consumer discretionary, healthcare, and financials. Also looking at the Dow, the components in the green being JP Morgan up 3%. Also Amazon higher as well. Amazon over on the NASDAQ 100, a leader along with some of the other Alphabet and Apple of the Mag 7s, but the other Mag 7s in red territory with NVIDIA down 0.6%. Microsoft also lower. And just taking a look at crypto, we did see some movement there. We did see Bitcoin that is at 92,500 for Bitcoin, and Ether, which has been rallying lately. ETH up 0.8% at 33.50 per token. Josh.
All right, thank you, Inez.
Thank you.
The Federal Reserve has delivered its widely expected third rate cut of the year. But what did Wall Street make of Fed Chair Powell's messaging after the rate decision? Yahoo Finance's Brooke DePalma joins me now with more. Brooke.
We're getting some rhetoric following the decision to cut by a quarter point here, and one expert on Wall Street calling this a very hawkish cut, among many others calling a similar tone from the Fed this afternoon. We heard from Capital Markets, who said that the new summary of economic projections shows that the FOMC will expect one more interest rate cut next year, but the range of projections is unusually wide, even if we exclude Stephen Myron's extreme views. He went on to say that either way, we doubt that the Fed will cut until after a new chair replaces Jerome Powell in May. Keep in mind, Jerome Powell's term does end in May. He went on to say within this note that, unsurprisingly, given the division that we're seeing within the Federal Reserve right now, the statement signaled a pause from here, noting that the FOMC will consider the extent and timing of additional adjustments to the target range. Now, on top of that, we also heard from Evercore ISI's Krishnan Guha, and what they said within this note was really an emphasis on the risk-on tone that Federal Chair Jerome Powell had said, or rather risk-friendly tone, that is, on productivity and growth. Particularly within that note, Krishna had said the take on productivity and growth is very risk-friendly. That is, the Fed chair suggests productivity may be running about 2%, allowing the economy to grow faster without generating excess inflation. Ultimately, lower rates, falling inflation, and faster economic growth will allow, leads to the Fed cutting interest rates, one more rate cut to come next year. Also worth noting that Jerome Powell was very upbeat around productivity and growth, including the way that AI is going to impact this. This was a bit of a different tone than he had back in the October meeting.
And what about, while we have you, see, I thought you were tossing to a sot there. I was waiting for the drama. I thought it was
waiting
coming.
for the drum roll, please.
Here comes more power. Right,
I mean, we could do a still drum roll. Santa Claus rally. Can I get you there?
While we have you, green across the screen here. I've got the Dow up 500 points. We have look at the S&P 500 up 0.7%. The NASDAQ up 0.3%. The pint-sized companies, the Russell 2000, 1.6%. What are folks weighing in on? How are they responding to that reaction? What do they make of it?
Yeah, well, obviously what we see here is a very optimistic tone across the street right now as we make our way into the latter part of this year. And we're getting optimism across the street that this momentum could continue. We can continue to see the S&P 500 push higher. Of course, we've got those very bullish 2026 outlooks with the S&P 500 going as much as 8,000 points if if the Fed continues to ease. That was out from JP Morgan earlier, rather last month. But today, this afternoon, we're hearing from Jose Torres. He's senior economist at Interactive Brokers. He said that the last interest rate decision of 2025 has essentially paved the way for a Santa Claus rally to end the year, with the S&P 500 expected to exceed the 7,000 milestone in the next few weeks. We're only 2 points away during this time away from that 7,000 mark. And so definitely keep an eye out. Of course, the S&P 500 now trading near, if not at, record highs at 6,886. I believe it's 6,890 to then cross another record high.
All right. Thank you, Brooke. Appreciate it. Let's turn now to some earnings. Looking at Oracle's second quarter results, they are just hitting the wires now. Q2 adjusted EPS, I see 226. Consensus there was at 164, so that's a beat on the bottom line. I'm looking at the top line now. Revenue clocks in at $16.06 billion. The estimate on the street was close to $16.21 billion, so that's a bit light on the top. I'm looking for operating margins. There they are right there. Q2 operating margins, 42%. The street was at 42.2%. I'm looking for the divisions here. Q2 cloud revenue, $8 billion. The street was at $8.04 billion. Cloud infrastructure revenue, $4.1 billion. The street was at $4.09 billion. RPOs, remaining performance obligations, that's a key metric there of future revenue, $523 billion versus an estimate of around $97 billion year over year. That was the comparison there, 523 versus 97 year over year. Remember, this one had been interesting to watch. I don't see yet the estimates for forecasts, looking for the guidance there. While I'm still looking, of course, this stock had been a dramatic one. Recall after the last time they reported, it had roared higher. Obviously, Oracle executives had convinced the street they were an AI winner, but then you saw the stock get whacked. You had these concerns bubble up about customer concentration risk with OpenAI specifically. You had concerns about debt risk that were brought up. How exactly was Oracle going to finance this great AI data center build out? Right now, at least initially, we see the stock down about 6% here in the after hours. Dan Halley, I know you're standing by. You're watching this print. So critical, not just for Oracle, but really the greater AI theme and trend and story. What are your initial takes here?
Yeah, Oracle's become a bellwether just because of the vast investments that it's making. Obviously, with OpenAI, they're part of that Project Stargate. They have that $300 billion agreement. But seeing them beat when it comes to EPS and coming in line with that infrastructure is rather interesting. I wonder how the street's going to respond right now. One thing that I think is worth pointing out is in the actual release. Let's see, we have CFO Doug Carrick basically saying that those remaining performance obligations, as you pointed out, a key metric just because that shows some of the revenue that hasn't been realized yet from various agreements, grew sequentially $68 billion to that $523 billion. And they talk about how that highlights new commitments from Meta, NVIDIA, and others. And so that's going to be something to watch. Obviously, this has been a company that with those kind of agreements has just kind of shot itself up to the level of something like a Microsoft or Google or not exactly NVIDIA, but that kind of rank when it comes to watching the AI trade. And so this is going to be a big test, I think, going into the aftermarket now and then into tomorrow when we start to see investors really continue to digest this news.
All right, thank you, Dan. Appreciate it. Well, for more on Oracle's latest quarterly results, let's get to Futurum CEO Dan Newman. Dan, the results are just hitting, at least initially here, Dan. Investors seem disappointed. I got the stock down about 6% in the after hours, but what do you make initially of the report?
Yeah, Josh, good to see you. There was an exuberance in the rise. There's been a exuberance in the fall, and I think this is another case of they can't do anything right at this exact moment for their investors. The company had that big OpenAI contract. I am an AI bull, and I do believe the demand is real. I do believe there's some risk with OpenAI, but I think if OpenAI was to falter in some way, that demand would be picked up elsewhere. I'm not sure that the street is fully appreciating that. But you saw they came in above on the EPS. where a lot of the complaints were about the company's ability to make money, ability to support its debt load, and that risk that came along with that big OpenAI contract. But at the same time, it looks like revenue was a little light. The OCI number was good, but it didn't blow anyone away. And so I think right now it's probably a little bit oversold. I think there's a bit of an underappreciation for the overall asset that is Oracle, and a bit of an over-rotation to just focus on that cloud business. When you know, Josh, because we've been covering this company a long time, that this is a company that has a very sturdy business outside of the cloud, and that's an upside part of their business, but there's been such a big focus on it.
Dan, so the last time they reported, right, the stock had this just historic move initially. And then clearly investors had questions. They had questions, as you brought up, about customer concentration risk with OpenAI. And they clearly had questions about debt risk here, questions about how exactly is Larry Ellison going to pay for this great AI data center build out. On the call, Dan, what are you listening for from Oracle executives on those two big topics, those big themes? What do you want to hear?
Of course, Larry Ellison's one of the best at telling stories. He's done it for decades now, and he's been able to continue to build shareholder value. But I think Oracle's always been one of those companies that's had to fight, some of the sentiment on the street. Maybe Oracle is not the big winner. And then when they'd just deliver, the investors would follow. But you could see with that kind of NVIDIA turn, when there was some concern about NVIDIA, some concern about OpenAI, Oracle went down really quickly with it. So what can he say? I mean, first of all, I think he needs to be confident in his strategy, and he knows he's having those conversations, whether it's around Stargate, whether it's around other builds, and of course, how the core business will continue to basically finance some of the growth that the company wants. So it's not just going to be debt. The whole company has to be operating, creating the cash flow, and supporting that bigger debt load and that bigger risk. But I think he also needs to reassure the street, much in the way Mark Zuckerberg does, to say, hey, look, we may be over-investing, but it's sure going to be better than us being on the wrong side of this. Mark had, going back to Meta, Mark may have gotten Reality Labs somewhat wrong, but he didn't get AI wrong, and he's making that big investment. Larry Ellison knows that software, as we know it today, is at risk. He's pivoting the company. He has an opportunity. He's got some really great contracts, including the OpenAI one, but he does need to prove to his investors that he's got deals and deal flow well beyond just that particular customer.
I know you're an AI bull, Dan, but when you see this print and the reaction, at least initially here to the print, does it get you at all concerned about the greater AI theme and trend we've talked so much about?
There's always little cracks. Like I said, there's a lot of companies that are being pulled along in this AI boom that may not be winners. That's part of being a super cycle, though. That's the difference between a bubble and a super cycle. Some companies get pulled, they will get blown up in the long run, Josh. But Oracle, no, I'm not that concerned about Oracle. And I'm also not concerned about the trade at large. I do think the demand will continue to be filled. But I think that in these gaps, in these periods of time from when a new data center gets built to the time that it's able to generate revenue, people sort of underappreciate that cycle. We have 65 gigawatts plus of data centers being built out. This does not happen overnight. These data centers take time, and so they can only grow as fast as they can expand capacity. So the business needs to be continuing to invest, continuing to expand capacity, and then show investors that it can fill that capacity, and ideally filling that capacity with workloads that are generating revenue, efficiency, productivity, and of course, seeing more of this business shifting to enterprise AI and beyond just LLMs.
And by the way, Dan, quickly while we have you, because Adobe is reporting as well, Q4 adjusted EPS 550, Street was at 539. Revenue 6.19 billion, Street was at 6.11 billion, and I'm just looking quickly what they're guiding for ahead. Q1 adjusted EPS 585 to 590, Street was at 566. This one, obviously you're walking into this print here, Dan, low expectations. This stock was down about 20% this year heading into this print. Many obviously concerned, Dan, with Adobe that at the end of the day it's going to be actually disrupted by AI. That's the skeptical take, the bearish take. What do you think?
I think that people are overestimated. I do think over the next 3 to 5 years that the overall software and SaaS market has some risk. I think Adobe is more sturdy, although people do see certain other disruptive companies, whether it be Figma or others, as very disruptive. OpenAI, whether it be using different LLMs to do certain functions in the content supply chain, for instance, that Adobe is very focused on, or document management, which is another thing that Adobe is well known for. But I think the asset is underappreciated, and much like CRM, Salesforce, which has been able to show some strong growth. I believe it was 3.2 trillion tokens that it discussed on its new agent platform. Adobe is making pivots. And one thing I think anybody out there that's followed software for a long time knows, or even a business owner or user of software knows, it's very sticky inside the enterprise. So solutions from companies like Adobe, people don't just rip them out as quick as you might think. So these companies have a little bit of time to get their customers to adapt to their new offerings. But I do think these companies have to be really on top of their game, be very innovative, and think about ways to use tokens or more consumption-based even pricing than they ever have before to give value and not see customers shift away onto new offerings.
All right, Dan, always great to see you and have you on the show. Thank you, sir.
Thanks, Josh.
Coming up, conversation with Apollo Global CEO Marc Rowan. That's straight ahead. The Federal Reserve cut interest rates by a quarter point today, but the path forward isn't as clear. Our own executive editor sat down with Apollo CEO Marc Rowan to discuss the outlook for monetary policy and what it means for private markets. Apollo is the parent of Yahoo Finance.
This is Fed decision day in America. In your view, what does getting policy right look like?
I don't know if there's a right answer here. Internally at Apollo, we do not think there's a need for a cut. There's nothing in the data that tells us, but at the same time, I understand the decision. But longer term, I'm not sure it really matters. I mean, if you think about what's happening, the market is ultimately determining the outcome. We have governments around the world who are borrowing record amounts of money. We are, for maybe good and valid reasons, fractionalizing our labor supply through immigration reform. We're fractionalizing our flow of goods through the other tariff and other measures, again, for good and valid reasons. Those things tend to be inflationary. And so a lot of what we're doing is inflationary. Certainly borrowing lots of money has the potential to be inflationary. Depreciating our currency has the tendency to be inflationary. And what we're seeing is a steepening of the yield curve. Rates that matter, the 10-year, are higher, even if short rates are lower.
What do you think the impact will be if we do in fact get another rate cut, and then if the Fed does embark on maybe one more next year?
I'm not sure. This is what's priced into the curve. I think at the end of the day, the short-term fluctuations of monetary policy, interesting but not all that relevant. It's ultimately about maintaining the confidence of the financial system and of the bond market, given the scale of borrowing that we and other Western governments need to do.
It's interesting to hear you say that we don't need another rate. Apollo, of course, has access to so many amazing businesses all around the world. What are you seeing in terms of the economy? Because GDP has slowed, jobs have slowed, so I think the market wants a rate cut.
Slowed from what? What's normal? We've gone from a period of time of COVID to massive stimulus to tariff shock. Tell me again what's normal? I don't know that we see normal. Things feel pretty good, and by the way, growth has been in that range, if not higher, from various points in time. Unemployment is at numbers that historically we used to call full employment. We also have mixed signals. We don't have as many workers, we therefore may not have as many jobs. It appears to me in our companies that things are just fine.
I really enjoyed an op-ed you wrote recently on private markets. You've been beating the drum on this. You gave a really good presentation at Goldman Sachs today on this. What are some things that people are not understanding about private markets?
Well, I think there are two big things that I've really focused on. First, the definition of private credit. In much of the financial press, private credit means levered lending, a below investment grade deal-related activity. And the reality is most private credit is investment grade. And most of the credit in the financial system that is private, banks, insurers, pension funds, is investment grade. There's a whole discussion about what private investment grade is and why it exists, but its competition is public investment grade. And generally, it has outperformed public investment grade both in return and in safety. Put that to the side. Much of the press is focused, as I said, on this notion of levered lending. A levered lending, a below investment grade activity, comes in two flavors. One flavor is the broadly syndicated type, which is typically underwritten by banks and then distributed. The other is that which is underwritten by asset managers and is typically held and is sometimes called direct lending. The big miss there is it's just an investment. It's like a stock or a bond. We don't think anything of NVIDIA or the S&P going up or down 10 or 15%. And yet, one private credit loan or one broadly syndicated loan defaults and people lose their mind. Why are people investing in levered lending? They're investing to reduce risk. Generally, what investors are doing is they're taking money out of equity or out of high yield bonds and moving into levered lending. It's roughly the same return and it is less volatile. And if you hate levered lending, you're really going to hate high yield. And if you hate levered lending, you're really going to hate equity. This is a de-risking activity, and it is mostly conducted by investors who are seeking to de-risk. And I just leave it there. We could go on all day and just talk about private credit.
When we saw some of those the pressures for Tricolor and First Brand, why do you think that really didn't spill over into the broader stock market? We saw some convulsions, but it wasn't like that worrisome move.
Why should it be? Companies default all the time. I mean, there's in some of the materials that we will put out later today, you'll see 20 years of defaults in the investment grade market, the levered lending market, and the high yield market. Well underwritten credit, even if it defaults, usually has very strong recoveries. The notion that something defaulted, okay, it defaults. The question is, was it a sign of something wrong in the economy? The answer from my point of view is no. This was just sloppy underwriting. In both those instances, the warning signs were there, it was avoidable. And by the way, both were underwritten in the banking system in the form of broadly syndicated loans. Forget that was not direct lending or asset manager driven direct lending. That was a factoid that people just didn't need.
I love this move with the Goldman today. Great fortunes will be made and lost in data centers. Explain it to us.
Well, we were talking about the notion of financing for data centers. And the point I was making is that as a credit investor, you want to get paid back before you get to renewal. Because it is very clear today and for the next few years that the demand for data is unbelievably strong. Therefore, for the next period of time, based on contracts going in today, we should have very safe cash flows in which to amortize credit. Ultimately, the return on equity, though, is a function of renewal. I have a chart on the wall in my office, which is just about energy usage in the year 2030, not that far away. And each of the good and great consulting firms have weighed in, and it looks like a child's scattered dart plot. The fact is, if experts looking out not all that far have no idea, we are making a fundamental bet on equity. And that bet is driven by technology, it's driven by chipsets, it's driven by energy usage, it's driven by quantum computing, and a whole host of factors that we are not yet considering. So I think as equity, people should be allowed to take that bet. Great fortunes will be made, great fortunes may be lost. We, in fact, are investors in data center equity under the right circumstances in the right way for the reasons that we believe we will get upside. But I don't think it is a foregone conclusion that because you own a data center and you own equity in it, and data is valuable, that you will make money in data center equity.
I didn't ask you about a bubble, so I'm going to ask it a different way. Are you concerned by how much debt some of these tech companies are taking to fund their AI ambitions?
I'd say concerned, I don't know. And I think tech companies is a broad term. For the most part, the hyperscalers are the largest and most successful companies that exist, not just in the US and worldwide. They have massive amounts of cash flow coming from lots of other businesses. And if I am worried about the debt of hyperscalers, the economy and the US have way bigger issues. So generally, I am not worried. But there's a whole series of intermediaries who are large owners of data capacity, who themselves are not in other businesses that afford them the luxury of using their credit rating and balance sheet to make massive commitments. And those companies essentially are the equity owners of data centers. levering those companies, given my previous comments, does not seem to be the safest thing I've ever seen.
We'll have to leave it there. No new toys. Is that still mantra?
Oh, that's old news.
That's old news? Okay.
Our business, in fact, our industry has been going through just massive amounts of change. We've gone from a business that historically had one market, the alts bucket of institutional clients, to now 6 markets. What is needed to serve those 6 markets is different than what was needed to serve just the one. And so we and our peer set are evolving our businesses based on how we each individually see the market developing, and we don't all see it the same way, which is what makes it fun.
Asking for a Trend is coming up next.